Welcome to Bloomberg Law. I'm Pacchia. Last week, investment bank UBS disclosed losses resulting from unauthorized trades totaling $2.3 billion. Joining me now to discuss is Chris Keller, partner at law firm Labaton Sucharow. Welcome.
Thank you very much for
Thanks for coming in. So this is an awful lot of money we're talking about. What happened here? How did a single individual trader go on to lose over $2 billion unnoticed over a period of time?
Well, unnoticed, we don't know yet. The final story has not been told, but certainly this individual's placed some very large bets.
This is being described as a criminal act, a rogue trader, if you will, evaded internal controls and caused the harm. What's the criminal act here? How is this different from an individual employee just not being very good at his or her job?
Yeah, I think to call it a criminal act is a little bit somewhat of a stretch in that this was not an act that was intended to immediately benefit him to the amount of $2.4 billion. His motivations may have been to certainly increase his compensation and otherwise, but he was out there trying to earn money for his employer.
Okay. Management responsibility in this instance. There's supposed to be internal risk controls. What happened here?
Well, we don't know. The last word certainly hasn't been written, and the investigations are just still underway.
What's an ideal system supposed to look like?
I would imagine a system of controls is intended to prevent exactly what happened at UBS, which is that positions that are on the books are verified, and that it's very difficult, if not impossible, for one individual acting on his own to circumvent that by simply creating fictitious positions.
What about regulators? This obviously happened in the United Kingdom, but what can government entities or regulators do to prevent instances like this from taking place? Is there anything that they can do?
Well, what's being debated currently is the issue of the Volcker Rule in connection with dodd-frank. Although it wouldn't directly regulate UBS, it would regulate UBS in an indirect way.
Now that prohibits banks from prop trading.
Correct.
Let's define proprietary trading.
Okay. Proprietary trading generally is understood to be trading on behalf of the bank and the bank's money, such that the profits go directly to the bank and the risks are also borne by the bank. Whereas trading on behalf of clients is usually where the bank, for lack of a better word, will act as the casino, but not one of the gamblers at the casino.
I mean, we're talking about a system that isn't confined to an individual country. This is something that happened in the United Kingdom, but there's nothing, at least from my vantage point, that prevents something like this from happening in the United States. Is that accurate?
Well, I think the United States leads the way and would lead the way in this regard. In fact, very recently I know that the regulators over in the UK have been talking seriously about putting into place something like a Volcker Rule, or as they refer to it as ring fencing certain risks that they perceive to be of a systemic nature. Will the Volcker Rule go into effect? It will. The question is, how will it be implemented? And that is very much an open issue. And certainly the banks are working very hard to make sure that the rules that are put in place provide them with the flexibility to continue to pursue profits as they have in the past.
But when we get to the issue at hand here, essentially we're talking about combining investment banking and commercial banking enterprises under the same roof. Does ring fencing, does the Volcker Rule, does it go far enough, or do we need something more along the lines of Glass-Steagall, the law from 1933 that, of course, mandated a separation of those two enterprises?
Many noted experienced professionals and respected regulators have called for the reinstatement of Glass-Steagall, which was a real wall between the investment banking activities and banking activities. The Volcker Rule has been referred to as Glass-Steagall Light because it allows certain activities the banks could still engage in, such as underwriting and certain other transactions in securities on their own account. It allows them and would allow them to maintain a market maker capacity. But the more that is carved out, the more opportunity there is to exploit that. And I think that that's the current debate. And how the rules finally look will depend largely upon what transpires over the next few months. The timing of this event and this egregious circumvention of any risk management that was in place certainly highlights the need to have, I think, more stringent rules in place.
Is there anything that prevents the next unauthorized trading crisis from being a much larger figure? I mean, we talk about $2.3 billion here. Is there anything that prevents it from being $23 billion next time around?
No, it's conceivable that we're talking about 2.3 today. We could be talking about 20.3 a year from today. I don't believe that that regulators have been able to keep pace with the movement of the markets and the globalization of our economy and of the financial markets, of the products that are being introduced to the marketplace, such as credit default swaps, which have been referred to by Warren Buffett as weapons of mass financial destruction, as well as now the rise of certain types of ETFs, which had been described and had been introduced to the marketplace, I think, as a very staid, conservative investment, and oftentimes used for hedging. But the notion of what an ETF does, you can use that to hedge anything, and raises the same risks that you'd have with like a credit default swap at some point.
Tough stuff. It doesn't sound like there's any easy answers to this problem.
There really isn't. You need a twofold approach to this. You need vigorous regulation and oversight by the regulators, and you need private enforcement, which is what is my day to day and how I spend my life, my life's work. You have a deterrent effect with private litigation, as well as a method of compensation. And with the regulators, you have the oversight and the deterrent effect. And I think that both together, being vigorous and vibrant, helps. It helps.
Just looking at this incident in isolation, and the one that the last previous large unauthorized trading crisis came out of Societe Generale. Is there anything that prevented this from happening in the United States? This seems to be something, at least the big ticket unauthorized trading losses seem to be happening outside the United States. Is there anything about our system that seems to be protecting us, or has it just been happenstance that hasn't occurred here yet?
I don't know. You're right. It does seem that you've had the Nick Leeson at Barron's Bank, you had Societe Generale, and now you have UBS. There was a recent instance of unauthorized trading involving MF Global, which I believe is about 2 or 3 years old, but that amount at stake was about $140 million.
Right.
So it can happen, and does happen in the U.S., but they certainly have had a run of bad luck over there.
Do you expect this episode to result in any meaningful civil litigation? Are shareholders going to ultimately sue the company for mismanaging internal control procedures?
Well, I think that UBS has staked out their position with respect to what happened here. If it turns out that it's anything other than as they represent, I think that they would face litigation, and rightfully so.
All right. Chris Keller from Labaton Sucharow, thanks so much for coming in today.
Thank you very much for having me.
If you'd like to learn more about the issues we just discussed, go check out our offerings on BloombergLaw.com and also on the Bloomberg Terminal. I'm Pacchia. Thanks for watching.